As many of you guys know, I work a full-time job. I trade on the side and I wake up every day in the morning to day trade, right? And day trading can be very difficult when you have a time restriction of needing to go to work at like 8 or 8:30 or 9 in the morning, right? As some of you guys know. So selling options, usually in the form of credit spreads, is my tool of choice when it comes to day trading because I have this time limitation. Well, I'm here to show you that it is possible. And I'm going to show you guys how to use credit spreads to day trade, but more importantly, how to manage these entries and exits to minimize your losses and consistently take profit. Welcome to the channel. This is Credit Spread Investing, where I show you the thought process and details behind the trade so that you too can learn and do it yourself. If you guys like thoughtful content like this, make sure you guys subscribe. It'll really help out the channel. First, what are credit spreads? A credit spread is an options trading strategy that involves simultaneously buying and selling two options on the same underlying asset. The goal of this strategy is to generate income by collecting premiums from the sold option while limiting the risk of loss by buying a cheaper option. Credit spreads are directional in nature, right? So there are really two types of credit spreads: bull put spreads and bear call spreads. A bull put spread is used when you expect the underlying price of the asset to rise, while a bear call spread is used when you expect the price of the underlying asset to fall. So let's take a look at Microsoft here. It's just 6 days out, expiry July 14th. We'll just click one that's really close to the money, 335, 332.5. Microsoft's currently sitting at 337.22. What we're doing here is we're selling the 335 strike price and buying 332.5, which is a 2.5 spread. Expiry July 14th. The difference between the 335 and 332.5 is $86. And so once this goes through, you will collect $86 right off the bat. And if Microsoft were to be above 335, you would collect max credit. You would make $86. If it were to fall below 332.5, you would lose the maximum amount, which would be 250 minus 86, which would be $164. If it ends somewhere in between, then it would just be the difference between the actual strike price and the actual price. So for example, if it ended up at 334, you would be losing $100 from the trade, but you collected $86, so the overall loss there would be 14. The profit loss ratio will look something like this on your screen, where your max profit will be 86 and your max loss will be 164, and anywhere in between 335 and 332.5 would be a linear line down until it hits that max loss. If you want to do a bear spread, it would be the opposite, except for the fact that you would be selling a call instead of a put. So let's just go again to the one strike above, so 337.5 and 340. Which in this case, you would be selling a 337.5 call and you would then be buying a 340. If Microsoft were to stay below 337.5, you would make max credit of $108. If it were to go above 340, your max loss will be 250 minus 108, which would be 142. Again, anywhere in between, the same math as what you would do on the bull side. If it was 338.5, which is $100, which means that you would then make a profit of $8 because you would lose $100 because it ended up in the money. Because you collected 108, your profit there will be $8. The profit and loss chart will look like this, very similar to what you saw on the bull side, but just flipped. Linear line between 337.5 and 340. Okay, so credit spreads are popular among traders because they really offer a limited risk and a limited reward potential, right? You make a certain amount and you can only lose a certain amount. But the beauty of this is that because you're selling options, right, you're receiving a credit, it's easier to manage. If you choose your entries correctly, you really have a better chance, in my opinion, of making consistent returns, especially for my case when I work full-time, having to go to the office at 8 and not being able to manage my trades as actively as I need to if I were buying options. Let's explore a couple of trades that I took on Thursday. I'll walk you through the whole trade, the thought process, and the systems that I use, again, so that you can understand how to do this. On Thursday, I sold an SPX on the S&P 500 index, 44.20, 44.25 call, and it collected a total credit of $85. So using what we just learned, I traded a 5-point call spread. My max loss in this case would be $425, but if it which is around a 17% ROI, again, which is really good for one day. I later on bought back that spread for $50, which means that I only made $35 a spread, but totally I sold two. So I made $70 on that one trade, which is again 7% ROI. But I decided to take a second trade here and I opened up a 43.85 and a 43.80 put spread in the bull direction. I collected $175 per spread, 35% ROI. I then bought that one back for $40 a spread, resulting in a profit of $135 a spread. Times that by 270 or 27% ROI. So on that one day, I made 340 bucks or 30% ROI using only $1,000. Again, you can see the power of scaling or compounding here. Went to work, right? And I was able to make 340. The whole point and the beauty of credit spreads are selling options as opposed to having to buy options. Now, a little bit more advanced, but by selling a call and a put option at the same time, I essentially opened up what we call an iron condor. My max loss doesn't change, right? Because the market can't end up above 43.80 and below 42.25 at the same time. So by doing that, I really changed my risk and reward to a max gain of $175 plus 85, right? The put and the bull added together to become 260. And my max loss would end up being around 500 minus 260, which equals 240. By opening up an iron condor, which is both a bull and a put spread, my max gain is now greater than my max loss, which means that no matter if I just let it expire out of the money, right? I didn't do anything, I would actually end up potentially making more money than I would lose money. Let's head over to charts so I can show you how to enter and manage these trades. I follow this trading principle called MAC. Market trend, area of interest, and criteria of entry. I would highly recommend that you guys watch this video linked in the upper right hand corner if you guys are new or need a refresher, because this really helps ground you and make sure that you guys don't enter bad trades. So let's take this principle and apply it to what I did on Thursday. I'll show you what you saw on Wednesday so that we can first understand what the trend is. You see that the market has hit a high here, went to a higher low, into a higher high at 44.58. So the market's kind of in this area, right? So you can see that the market in the long term is in an uptrend. However, if you zoom in a little bit into this specific area, you can see that the market has kind of stagnated a little bit. Went from a low to a high, to the same low, I would say, right around here, but then formed a lower high maybe at 44.50, failed to break to the 44.60 and kind of double topped right here into 44.52. So knowing this, you're kind of seeing that the market trend could potentially shift to a downtrend in the short term on Thursday, which means that we can either trade it one of two ways. We can either trade into this area, which is 44.60. If it ever breaks past 44.60, we can look to take a bull trade. Or if it ever breaks below this 44.37 level, which is the previous support, then we could trade in a bear direction. So these are your two areas. Area of interest is above this and below that. And the reason for that is because you know what the trend is. You know that the uptrend, the long term is in an uptrend, but the short term could potentially reverse into a downtrend. Because what happens if it falls down, then this is the area that you're looking at for potentially a rebound. If it goes up, then the sky's the limit. And so you can kind of see it. So now that we have that, we're going to look for criteria of entry into entering this play. If it's going up, I can potentially be looking for a very strong break of structure. It passes 44.60, coming back down to test and confirm. And if it's going to break this, I want to see a large break again down onto the level, some resistance or some form of weakness, potentially into a form of a higher low or a very strong bearish engulfing candlestick, something to allow me to enter this trade. So I'm going to look for a C when I'm trading on Thursday. Okay, so let's go. So on Thursday, it opened down past this 44.20 level, which is great, which means that we're now potentially going to enter in a bear trade. Now the question is, how do we enter? What allows us to enter? So I usually trade on the 5, just FYI, because 5 gives you a little bit more information. So this is Thursday, right? And so what I'm usually looking here for, again, is a criteria of entry. This is usually a really good signal. I don't want it to rebound. We've seen it where it opens into an area, right? And then market just rebounds some of this. And I'm looking for signs that that's not going to happen. So my pattern or my criteria of entry is that if it breaks the low of the day, then I'll decide to enter this trade. So if it were to bounce up, right, it could close the gap all the way up to maybe here, 44.40, or even up to 44.20. And you just don't want that. And so you want to see continued weakness. So for me, it's either a large break of this structure, which happened at 6.50. On this candlestick right here, I decided to enter at a very, very conservative level, 44.20, 44.25, which is basically where it opened on the day. The reason for that is actually, again, very simple. If you zoom out to the 30-minute, you'll see that the market, like we talked about, is still in an uptrend. If you're trading bear into a long-term uptrend, you got to be quick. This is why understanding what the trend is M, allows you to set your strategy and your take profits and stop losses accordingly. Really concerned about is it hits a certain level and it bounces up. And you can see that I'm already alluding to this. At the end of the day, you can see that it recovers, got up to 44.18. So you want to make sure that you're not selling right at this level because you're selling into a uptrend. What's the next level that I can sell at? Remember, we talked about this earlier. This is an area of interest because, again, into a long-term uptrend, this is the previous resistance turned to a support that caused it to gap up, right? So this is another area that we're looking at. So once it enters into this area, as you can see, I'm looking for signs of strength, indications that the market respects this level as an area of support. A strong signal like a bullish engulfing candlestick with large volume, or maybe a break of structure to form a higher high, right? So that this downtrend that you're seeing here ends. And I found that structure right here. So I'm gonna draw another line right here. I know there's a lot of lines here, but I'm gonna move this line up actually, just so that we can be clear. If it breaks, so this is the downtrend, right? It goes up and this is a previous high and it kind of fought around here and it broke down. So the moment it breaks past that, I guess, high and stays above it, which it did at 8:30, 8:35, that's when I would decide to enter, and that's what I did. And once it broke past it, I'm like, good, we're good to go. We're gonna enter this trade and we're gonna sell that put at 43.85, 43.80. Again, I'm selling it pretty aggressively because this is an uptrend, right? A market still in the uptrend. The pullback has theoretically ended, and I wanna make sure that I can ride that wave up. So I sold it very aggressively at 43.85 and it rode it all the way up. Okay, so around 10 o'clock or 10:05, that's when I had time to look at the phone during work. And you can play this one of two ways. Like, I already made $340 on this day. At this point in time, I'm like, I can either take the profit, which is around 70% of my max profit, right? Which is around 70% of my max profit, or I can just let it ride. And for me, I could have set a stop loss and at 50% each or something like that and just let it run. And I probably would have been fine. But I decided on that day, because I didn't want to even look at my phone because I was really busy at work, I just had to just take the profit and it just exit out both legs, both the puts and the calls on at 10 for a $340 profit. However, you can see that if you set your trailing stop losses, or if you follow this formula, which I will link in the upper right hand corner, which I have a step function or step ladder stop loss, which I did for 3 months and I made 471%. You can follow this. If you were to take that strategy and that option, you can theoretically just wait until the market closes and you probably would have made max profit, because the market closed, hit a high of 41.16 and ended at 41.10, which means that you're actually in between your two legs. You would have made the max profit if you just followed a very basic stop loss structure. I didn't do that this day. I decided not to. I took the profit early. Again, I would recommend you guys watch that video. I'll link it upper right hand corner, 471% in 3 months with that very simple stop loss strategy. Beauty of selling options, because you don't actually have to target a price point. You can just let it expire out of the money. Okay, let me know if you guys have any questions down in the comment section below. If you guys have done this in the past, we'd love to hear your thoughts and your questions. And if you guys want to see again some other trades about how I trade credit spreads on zero DTEs, make sure you guys check out this video linked in the end screen right here for even more examples of how to trade credit spreads daily. All right, until next time, stay safe in the market. Peace.